There's a question that haunts the portfolio of every retail investor. It's a quiet doubt that surfaces after the market closes. In the stillness of a portfolio review, when the numbers on the screen don't match the story you were told. The question is this: why isn't this working? You did everything right. You found the company with the explosive story, the one featured in all the headlines, the one with revenue charts that look like a rocket launch. You bought into the narrative of growth, the promise of a stock that was destined to change the world and, in the process, deliver you to a state of financial freedom. Yet your portfolio growth is stagnant. The stock moves sideways, or worse, it bleeds out, day after day, a slow and agonizing decline. You've become a victim of the single most dangerous lie in modern finance, the idea that all growth is good growth. Warren Buffett, in his decades of navigating the treacherous currents of the market, uncovered a fundamental truth that separates the fortunes of the wealthy from the frustrations of the crowd. He realized that most of what Wall Street sells as growth investing is a scam. It's a siren song that lures investors toward companies that are, in reality, financial black holes. Businesses that grow bigger but not richer. They are capital guzzlers, expanding by consuming vast and ever-increasing amounts of investor money, only to produce pathetic returns on that capital. They are like a bodybuilder who gains 100 pounds of fat instead of muscle. They are larger, but fundamentally weaker. The true path to beating the market, to achieving the kind of compounding that builds dynasties, lies in a subtle but profound distinction. It is the ability to separate a mere growth business from what Buffett calls a franchise. A franchise is a different species of enterprise entirely. It is a business that possesses a unique economic characteristic so powerful that it can grow and, simultaneously, gush cash. It doesn't need to beg for money to expand. Its own success funds its future dominance. Understanding this difference is not just another stock-picking tip. It is the master key to unlocking genuine, sustainable wealth. It is the final promise that can transform your entire approach to the market, turning you from a speculator chasing stories into a proprietor buying pieces of truly exceptional businesses. This journey we are about to embark on is a deep dive into this core principle of quality investing. We will deconstruct the mental models that govern Buffett's thinking, providing a level of financial education that is typically reserved for the gilded halls of private equity and high-level wealth management. We will explore the illusion of growth that traps the 99% of investors, and we will build, piece by piece, the intellectual toolkit you need to identify the compounding machines. This isn't about a hot stock tip for next week. This is about rewiring your brain to see the market not as a casino, but as a landscape of businesses, some of which are destined for mediocrity, and some of which are engineered for greatness. For entrepreneurs watching, this is a blueprint for building a business that creates real value. For the retail investor, this is your map to finding market alpha. Mastering this single distinction is the critical step toward achieving true portfolio growth and, ultimately, the financial freedom you seek. Let's begin by dissecting the very idea of growth and defining the elusive concept of a franchise. Imagine for a moment it's the early 1970s. The air is thick with economic uncertainty. The Nifty 50 boom, where investors paid any price for large established growth stocks, is beginning to show cracks. Inflation is a growing cancer on the economy. In Omaha, Nebraska, a young but already successful investor named Warren Buffett is grappling with this exact problem. He's managing partnerships, he's building his company Berkshire Hathaway, and he's looking for a place to deploy capital. But he's not looking for the next hot technology or the fastest growing company. He's looking for something different, something durable. In 1972, an opportunity crosses his desk, presented by his partner, Charlie Munger. It's a family-owned box chocolate company based in California called See's Candies. On the surface, it seemed unimpressive, almost quaint. This wasn't a semiconductor company or a global conglomerate. It was a regional candy maker. The family wanted to sell for $30 million. The company was earning about $4 million pre-tax, which meant it was earning about $2 million after tax. Buffett's first reaction, and the reaction of almost any conventional analyst at the time, was one of skepticism. A price of $30 million for a company earning $2 million was a price-to-earnings ratio of 15. This was not a classic deep-value cigar-butt investment that he had built his early career on. It seemed expensive, especially for a business as simple as selling chocolates and bonbons. His associate, another sharp mind at Berkshire, calculated the book value, the tangible assets of See's, the stores, the equipment, the inventory. It came out to only $8 million, so the sellers were asking for a $30 million price tag for a business with only $8 million in hard assets. The extra $22 million was for something intangible, something the accountants called goodwill. For a value investor trained to buy assets for pennies on the dollar, paying a massive premium for goodwill seemed like madness. Buffett initially balked at the price. He offered $25 million. The sellers, the See family, held firm at $30 million, and for a moment the deal was dead. But Charlie Munger persisted. Munger saw something that the raw numbers didn't immediately reveal. He saw the franchise. He understood that See's Candies wasn't just a collection of assets that produced chocolate. It was a beloved institution in California. For decades, when a customer wanted to buy a gift for Valentine's Day or Mother's Day, or simply bring a treat to a dinner party, the name See's popped into their head. The brand was seared into the consumer's mind with associations of quality, nostalgia, and tradition. This mental monopoly meant that See's had pricing power. Every year, they could raise the price of their chocolates by a little bit, and their loyal customers wouldn't flinch. They weren't comparing the price of See's to a generic chocolate bar at the supermarket. They were buying the experience, the trust, the iconic black and white box. Munger convinced Buffett to look past the high purchase price and see the underlying economic reality. They were not buying $8 million of assets. They were buying an economic franchise that produced $2 million a year in earnings and, crucially, had the ability to increase those earnings without requiring significant new capital investment. They paid the $30 million. What happened next became a foundational legend in the history of capital allocation. See's Candies became what Buffett would later call the all-American business. It required minimal capital. The stores were simple. The equipment lasted for years. The business didn't need to spend hundreds of millions on research and development to invent a new kind of chocolate. It just needed to keep doing what it had been doing for 50 years. But because of its brand power, it could raise its prices year after year. Those price increases dropped almost directly to the bottom line. The initial $2 million in after-tax earnings grew and grew. More importantly, that profit was free and clear. It was cash that didn't need to be plowed back into the business just to stay competitive. It was cash that could be sent to Omaha, to Buffett, to be deployed in other wonderful businesses. Over the decades, See's Candies would go on to generate over $2 billion in profits for Berkshire Hathaway, all on that initial $30 million investment, and it did so with very little additional capital being put into the business. It was a gusher of cash. This was the moment the light bulb truly went on. A franchise business is one that earns high returns on the capital it employs because it has a durable competitive advantage, a moat that protects it from competition. It's not about how fast a company is growing its revenue. It's about the quality and profitability of that growth. See's wasn't growing its store count by 50% a year, but the value of its franchise was compounding beautifully. The psychological trap that causes most investors to miss a See's Candies and instead chase a capital-guzzling growth stock is a potent combination of two cognitive biases, the narrative fallacy and confirmation bias. The human brain is not wired to process spreadsheets. It's wired for stories. The narrative fallacy, a term coined by Nassim Taleb, describes our tendency to create and believe coherent stories, to explain complex, random facts. A company with a charismatic CEO, a revolutionary new product, and a story about disrupting an entire industry is intoxicating. We hear the story, we get excited, and we want it to be true. We see revenue growing at 100% year over year, and it seems to confirm the exciting narrative. This is where confirmation bias kicks in. We start actively seeking out information that supports our initial belief, the story, and we subconsciously ignore or dismiss information that contradicts it. So when we see a growth company, say a new electric vehicle manufacturer, we focus on the story, the visionary leader, the sleek design, the mission to save the planet. We see the surging delivery numbers as proof that the story is coming true. What we ignore, because it complicates our clean narrative, is the ugly reality on the cash flow statement. We ignore the $10 billion in capital expenditures to build a new factory. We ignore the billions spent on battery research. We ignore the constant need to raise more money by issuing new stock or taking on debt, diluting our ownership and adding risk. We confirm our belief with the top-line revenue growth and ignore the bottom-line cash burn. The franchise concept, as illuminated by the See's Candies example, is a direct antidote to this psychological poison. It forces you to abandon the seductive narrative and ask a colder, harder set of questions. It forces you to ask not how fast is it growing, but how profitable is that growth. It forces you to look past the income statement's revenue and look at the balance sheet and cash flow statement to understand how much capital is required to generate a dollar of profit. So how can we, as retail investors, translate this powerful concept into a practical tool? We can create a mental model, a blueprint, called the franchise versus commodity business filter. Before you even think about buying a stock, run the underlying business through this simple 4-part checklist. Question 1. Does the product or service have a unique and powerful identity in the customer's mind? Think about Coca-Cola versus a generic store brand cola. Think about an iPhone versus a generic Android phone. Think about a Tiffany engagement ring versus one from a mall kiosk. If the brand name itself creates value, desire, and trust, you might be looking at a franchise. Question 2. Is the business relatively free from the tyranny of price? In other words, does it have pricing power? Can it raise its prices modestly each year without losing its customer base to a cheaper competitor? See's Candies could. Moody's, the credit rating agency, another classic Buffett investment, certainly can. If a company's only competitive tool is to be the lowest cost provider, it is almost certainly not a franchise. It's a commodity business locked in a brutal, margin-crushing war. Question 3. Does the business require large, continuous capital expenditures to stay competitive? A steel mill needs to constantly spend hundreds of millions on new furnaces just to keep up. An airline needs to spend billions on new planes. A franchise, like the concentrate division of Coca-Cola or the royalty business of a software giant, requires very little new capital to grow its sales. Its main asset is intangible, the brand, the patent, the code, and it can be scaled almost infinitely with minimal cost. Question 4. If you were given a blank check with unlimited capital, could you easily and successfully replicate this business? You could be given $100 billion, and you could not create another Coca-Cola. The brand equity, the global distribution network, the century of consumer habit. It's impossible to replicate. You could, however, with enough capital, start another airline or another solar panel manufacturer. The harder it is to replicate, the stronger the franchise. This 4-question filter shifts your focus from the fleeting story of growth to the durable reality of economic power. The path of the 99%, the antithesis of this approach, is to ignore this filter entirely and get swept up in the mania of growth for growth's sake. The most catastrophic example of this in modern history was the dot-com bubble of the late 1990s. It was an era built entirely on narrative. The story was the new economy, where profits didn't matter, where eyeballs and user growth were the only metrics that counted. Companies like Webvan and Pets.com became market darlings. Webvan had a compelling story, revolutionizing the grocery business with online ordering and home delivery. Its revenue growth was astronomical, but the business model was a capital-guzzling nightmare. They spent hundreds of millions of dollars building massive, automated warehouses and a fleet of custom delivery vans. They were spending capital at a ferocious rate, with no hope of ever earning a decent return on it. The growth was not just unprofitable, it was value destructive. Every new customer they acquired actually cost them money. Pets.com had the same problem. A cute sock puppet mascot and millions in Super Bowl advertising drove brand awareness and revenue growth, but the underlying economics of shipping heavy bags of dog food for free were abysmal. Investors, blinded by the narrative of internet growth, poured billions into these companies. They ignored the fact that these were not franchises. They were commodity businesses, groceries, pet supplies, with a fantastically expensive and inefficient delivery model tacked on. When the narrative broke and the cash ran out, these companies didn't just fall. They evaporated, wiping out nearly all investor capital. They chased growth and found ruin because they never stopped to ask if it was the right kind of growth. The direct financial connection. The reason this distinction is the bedrock of wealth management and portfolio growth all comes down to one thing: free cash flow. Free cash flow is the lifeblood of a business. It's the cash generated by the company after accounting for the capital expenditures necessary to maintain and grow its operations. A franchise business, by its very nature, is a free cash flow machine. Because it doesn't require massive capital investment, a large portion of its earnings converts directly into cash that can be used to benefit shareholders. It can be paid out as dividends, used to buy back stock, increasing your ownership percentage, or retained to make intelligent acquisitions. A capital-guzzling growth business, on the other hand, is often a free cash flow desert. It might report high net income on its income statement, but when you look at the cash flow statement, you see that all of that profit, and often much more, was immediately consumed by capital expenditures. The company is on a treadmill, running faster and faster, growing revenue just to stay in the same place, generating no cash for its owners. The ultimate goal of stock picking and any form of quality investing is to own a stream of future cash flows. A franchise provides a large, growing, and defensible stream. A bad growth company provides a mirage, the promise of future cash that never seems to arrive. By learning to distinguish between the two, you stop buying lottery tickets based on exciting stories and start buying pieces of predictable, cash-generating economic engines. This is the first and most crucial pillar in building a portfolio that doesn't just grow, but endures. Now that we have established the conceptual difference between a franchise and a mere growth business, we must move from the abstract to the concrete. How do we measure this quality? How do we take the beautiful idea of an economic franchise, as exemplified by See's Candies, and translate it into a hard number, a quantitative litmus test that can guide our investment decisions? For Warren Buffett and the world's most successful practitioners of quality investing, the ultimate metric is not the P/E ratio, it's not earnings per share growth, and it's certainly not the stock price. It is the return on invested capital, or ROIC. This single figure tells you more about the underlying quality of a business than almost any other. It measures how efficiently a company is using its capital, both debt and equity, to generate profits. A company that can consistently generate a high ROIC is, by definition, an excellent business. A company that generates a low ROIC, no matter how fast its revenues are growing, is a mediocre business at best and a wealth destroyer at worst. To truly understand the power of this metric, we must travel back in time once again to 1973, shortly after the See's Candies acquisition. The stock market was beginning to crumble. The Nifty 50 stocks were collapsing under the weight of their own absurd valuations and a souring economy. It was a time of fear and pessimism. Yet, it was in this environment of gloom that Buffett made one of his most brilliant and instructive investments: the Washington Post Company. At the time, newspapers were seen as a mature, even declining industry. They were capital-intensive, with massive printing presses and fleets of delivery trucks. Most newspapers were locked in brutal competition, with rivals in their own cities, fighting for advertisers and readers, a classic commodity-like struggle. But the Washington Post was different. In its home market of Washington, D.C., it had become a dominant force. It was the paper of record, the one that every politician, lobbyist, and government worker had to read every morning. It had achieved a local monopoly, a true franchise in its specific market. Buffett began his stock analysis not by looking at the stock price, but by dissecting the business itself. He saw that the Washington Post Company was earning around $10 million after tax. The stock market, in its panic, was valuing the entire company at just $80 million, a P/E ratio of 8. To the average investor, this might seem cheap, but Buffett went deeper. He asked the critical question: how much capital did it take to generate that $10 million in profit? He recognized that the massive, expensive printing presses, while a big number on the balance sheet, were not the true source of the company's earning power. The true asset was the franchise, its dominant position in the mind of the Washington, D.C. reader. This franchise required almost no capital to maintain, yet it allowed the company to generate enormous profits. He calculated that the business was earning a spectacular return on the capital it actually needed to operate. He saw a business with a powerful moat, temporarily mispriced by a fearful market. He began buying shares aggressively, investing over $10 million, a significant sum for Berkshire at the time, to acquire a large stake in the company. His investment in the Washington Post was not a bet on the growth of the newspaper industry. It was a bet on the enduring profitability of a specific economic franchise. And that bet paid off spectacularly. The $10 million investment would, over the next 3 decades, grow to be worth over $1 billion. The key was that the Post, as a franchise, generated far more cash than it needed to reinvest in its own business. This excess cash was used to buy back shares and make other smart investments, all of which compounded the value for shareholders like Buffett. The lesson is profound. By focusing on the return on capital, Buffett was able to see the incredible economic engine hidden inside a business that the rest of the market had dismissed as part of a dying industry. ROIC was his X-ray vision, allowing him to see the quality of the business's bones irrespective of the market sentiment. This is a critical discipline for any retail investor seeking to achieve genuine portfolio growth. The psychological reason most investors fail to use a powerful metric like ROIC is a combination of 2 potent biases: anchoring bias and the focusing illusion. Anchoring bias is our tendency to rely too heavily on the first piece of information offered when making decisions. For most investors, that anchor is the stock price. They see a stock is at $50, and their entire analysis revolves around whether it will go to 60 or drop to 40. They anchor on the P/E ratio, thinking a P/E of 10 is cheap and a P/E of 40 is expensive, without any context for the quality of the underlying business. The focusing illusion complements this by causing us to place too much importance on one aspect of an event or decision. We focus on quarterly earnings growth or a single news headline, believing it to be the most important factor, while ignoring the more fundamental long-term drivers of value. Focusing on return on invested capital shatters these biases. It forces you to lift your gaze from the distracting ticker tape and evaluate the business as a business owner or a CEO would. A CEO doesn't just care about this quarter's profit. They care about how much capital they had to deploy to generate that profit. Were they able to turn $1 of investment into 20 cents of profit, or just 2 cents? This is the fundamental question of capital allocation, and ROIC is its scorecard. When you start your stock analysis with the question, what is this company's return on invested capital, and has it been consistently high? You are immediately de-anchoring from the stock price and focusing on what truly matters, the economic efficiency of the enterprise. This shift in perspective is the foundation of quality investing and a crucial piece of financial education. Let's translate this into a practical, applied mental model for you to use. We'll call it the back-of-the-envelope ROIC calculation. You don't need a PhD in finance to do this. You just need a company's financial statements and a calculator. Step 1. Find the net operating profit after tax, or NOPAT. This is the company's operating income, found on the income statement, adjusted for taxes. It tells you the pure, unlevered profit generated by the core business operations. Step 2. Find the invested capital. This is the amount of money the company has used to build its operations. A simple way to estimate it is to take total assets from the balance sheet and subtract non-interest-bearing current liabilities, like accounts payable. This gives you a good proxy for the total capital, both debt and equity, that has been entrusted to management. Step 3. Divide NOPAT by invested capital. The resulting percentage is the ROIC. Now, let's see it in action. Imagine two companies. Company A is a hot tech company. It's growing revenues at 50% a year. It generates 100 million in NOPAT. But to do this, it has required 2 billion in invested capital, factories, R&D labs, etc. Its ROIC is 100 million divided by 2 billion, which equals 5%. Now consider Company B, a boring software company that provides essential payroll services. It's only growing revenues at 10% a year. It also generates 100 million in NOPAT. But because its business is asset-light, it only required 500 million in invested capital. Its ROIC is 100 million divided by 500 million, which equals 20%. The average retail investor, seduced by the narrative of growth, flocks to Company A. But the sophisticated investor, the one focused on quality, knows that Company B is a vastly superior business. For every dollar invested in its operations, it generates 4 times as much profit as Company A. Company B is the true compounding machine, the business that can fund its own growth and still have cash left over for its owners. Company A, despite its flashy growth, is on a treadmill, requiring enormous amounts of capital just to produce a meager return. It is far more likely to disappoint investors in the long run. The path of the 99%, the antithesis of this disciplined quantitative approach, is to rely on flawed or incomplete metrics. The most notorious of these is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Wall Street analysts and company executives love to talk about EBITDA because it almost always presents a rosier picture of profitability than reality. Charlie Munger has famously said that the word EBITDA should be stricken from the English language, calling it bullshit earnings. Why? Because it ignores two very real costs of doing business. Depreciation and amortization are not just accounting fictions. They represent the real cost of assets wearing out and needing to be replaced. For a company in a capital-intensive industry, like an automaker or a telecommunications company, capital expenditures are a massive and recurring cash expense. To present earnings before accounting for this cost is financial malpractice. It's like calculating your personal salary but ignoring your mortgage and car payments. A focus on a metric like EBITDA can make a terrible, capital-guzzling business look attractive. It hides the very cancer that a high ROIC is designed to detect, the insatiable need for more capital to generate profits. Beating the market requires you to see past these deceptions and focus on true, cash-based returns on capital. The direct financial connection between a high ROIC and building wealth is profound and mathematical. It relates directly to a company's ability to self-fund its growth and compound its intrinsic value. When a company's ROIC is significantly higher than its cost of capital, the interest rate on its debt, and the expected return for its equity, it creates value with every dollar it reinvests. A company with a 20% ROIC that reinvests its profits is creating 20 cents of value for every dollar it puts to work. A company with a 5% ROIC in an environment where the cost of capital is 8% is actually destroying value. For every dollar it reinvests, it is destroying 3 cents of shareholder wealth. This is the hidden danger of bad growth. The company gets bigger, its revenues increase, but the intrinsic value per share is actually shrinking. A high ROIC, therefore, is the sign of a business that has options. It can fund its growth organically, without needing to constantly tap the capital markets, by issuing new shares, which dilutes your ownership, or taking on excessive debt, which increases risk. This financial self-sufficiency is a hallmark of quality. It allows the company to be the master of its own destiny, to invest for the long term, and to return excess capital to shareholders through dividends and buybacks. This is how portfolios are built. You identify these high-return businesses, you buy them at reasonable prices, and you let them work their compounding magic for years, even decades. The return on capital is not just an academic metric. It is the quantitative signature of a true economic franchise. It is the number that separates the wealth creators from the wealth destroyers, and it is the second pillar in your quest for market alpha. We have established the definition of a franchise and armed ourselves with the key metric, return on invested capital, to identify one. But a number, no matter how powerful, only tells you tranny up is happening. It doesn't tell you tranny up is why. Why is one company able to generate a 30% return on capital year after year, while its competitors struggle to earn 5%? The answer lies in the third and perhaps most important pillar of quality investing, the qualitative moat. A moat, in Buffett's parlance, is a durable competitive advantage that protects a business from incursions by rivals, much like a real moat protects a castle. It is the source of the franchise's power. It is the structural reason behind the high returns on capital. Identifying and understanding the nature of a company's moat is not just an analytical exercise. It is the key to predicting whether its high returns are sustainable or merely a fleeting moment of success. A great business isn't just profitable today. It has a structural advantage that makes it highly probable it will remain profitable for decades to come. The quintessential story of identifying a moat is Buffett's iconic investment in the Coca-Cola Company in the late 1980s. The stock market had just crashed in October of 1987, and fear was rampant. But Buffett wasn't looking at the market's panic gyrations. He was, as always, studying businesses. He had been a consumer of Coca-Cola his entire life, drinking at least 5 a day. But he began to study it as an investor. He went to the company's annual reports and was stunned by what he saw. The consistency of its growth, the global reach, the incredible profitability. He asked himself a simple question: what is the source of this power? It wasn't the secret formula, which, while valuable, could probably be replicated chemically. It wasn't the bottling plants, which were capital-intensive and often owned by others. The source of Coca-Cola's franchise power, he realized, was an intangible asset of almost incalculable value: its brand. The word Coca-Cola and the iconic red and white script were seared into the minds of billions of people across the planet. It wasn't just a beverage. It was a symbol of happiness, refreshment, and American culture. This mental real estate was the company's ultimate moat. When a person anywhere in the world felt thirsty and wanted a soda, the first thought that popped into their head was Coke. This top-of-mind awareness meant that Coca-Cola didn't have to compete on price with generic colas. It could charge a premium, and people would happily pay it because they were buying the feeling and the trust associated with the brand, not just the carbonated sugar water. Furthermore, he saw that the core business, selling the syrup concentrate to bottlers, was fantastically profitable and required almost no capital. The brand did all the heavy lifting. Once the brand was established, they could sell billions of dollars of concentrate with minimal additional investment. This was the perfect franchise, a dominant, intangible asset that produced sky-high returns on capital. Convinced of the moat's durability, Buffett invested over $1 billion in 1988 and 1989, buying up a huge chunk of the company. It became one of his greatest investments, a testament to the power of identifying a qualitative moat and betting on it with conviction. The psychological forces that create and sustain these moats are often the very same cognitive biases that trap unsuccessful investors. Consider the power of social proof and the bandwagon effect. These biases describe our tendency to assume that the actions of others reflect correct behavior in a given situation. We do things because other people are doing them. This is the engine behind a network effect moat, Why do you use Microsoft Windows? Primarily because everyone else, your colleagues, your clients, software developers, uses Windows. The value of the operating system increases for you as more people join the network. Why do you use Facebook or Instagram? Because that's where your friends are. It would be pointless to be on a social network by yourself. This self-reinforcing loop creates a powerful moat that is incredibly difficult for a new competitor to overcome, even with a technically superior product. Similarly, a brand moat like Coca-Cola's is built on decades of social proof. We drink it because our parents drank it, because we see it at every sporting event, in every movie. It's the default, the socially accepted choice. Buffett's genius is in recognizing how these predictable patterns of human psychology manifest as durable economic advantages for a business. He doesn't fight these biases. He invests in the companies that have successfully harnessed them. To make this actionable, we can adopt a mental model developed by investment analyst Pat Dorsey, which organizes competitive advantages into 4 distinct categories. This is the 4 moats checklist. When you analyze a company, you should be able to clearly identify which, if any, of these moats it possesses. The first moat is intangible assets. This includes brands like Coca-Cola or Nike, patents, which protect a pharmaceutical company's blockbuster drug, or regulatory licenses, like the ones that give a utility company a monopoly in its service area. These are powerful assets that prevent competition. The second moat is switching costs. This exists when it is too expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Think about your bank. Moving all your automatic payments and direct deposits is a huge hassle, so you stick with your current bank even if a new one offers a slightly better interest rate. Enterprise software companies are masters of this. Once a large corporation has integrated SAP or Oracle software into its core operations, the cost and risk of switching to a new system are astronomical. The third moat is the network effect, which we've discussed. The product or service becomes more valuable as more people use it. Examples include credit card networks like Visa and MasterCard, social media platforms, and online marketplaces like eBay or Airbnb. The fourth moat is a cost advantage. This allows a company to produce its product or service at a lower cost than its rivals, enabling it to either undercut them on price or earn higher profit margins. This can come from proprietary process, as with a uniquely efficient manufacturing technique, superior scale, like Walmart's massive purchasing power, or access to a unique, low-cost source of raw materials. By using this checklist, you can move from a vague feeling that a company is good to a precise understanding of the source of its competitive strength. This level of stock analysis is what separates the amateur retail investor from the professional. The antithesis, the path of the 99%, is to mistake a temporary advantage for a durable moat. This is one of the most common and costly mistakes in growth investing. A company can have a hot product, a first-mover advantage, or a period of rapid growth that looks like dominance, but if there is no underlying structural moat, the competition will inevitably come and erode its profitability. A classic example is GoPro. In the early 2010s, GoPro was a market sensation. It created a new category of action cameras, and its growth was explosive. The stock soared after its IPO. Investors were captivated by the brand and the exciting user-generated content it enabled. It looked like a franchise, but what moat did it really have? It had no significant patent protection on the form factor of a small, durable camera. It had no real switching costs. A customer could easily buy a camera from Sony or another competitor for their next purchase. It had no network effect. And while it had an early brand advantage, that brand wasn't strong enough to command a permanent price premium against a flood of cheaper knockoffs and competitors with better technology. GoPro's high returns on capital were temporary. As competition flooded the market, prices fell, margins collapsed, and the stock price cratered, destroying billions in shareholder value. Investors who mistook its fleeting product leadership for a durable moat paid a brutal price. This is the fate of countless moatless growth companies. Their success is a candle in the wind, destined to be extinguished by the gales of competition. The direct financial connection between a strong moat and superior investment returns is found in the concepts of pricing power and margin stability. A company with a true franchise protected by a deep and wide moat can consistently raise its prices at or above the rate of inflation without losing significant business. This pricing power is the engine of long-term value creation. It allows the company to protect its profitability from rising costs and to grow its earnings even in a stagnant economy. You can see this directly on the income statement. A company with a moat will exhibit stable or, ideally, expanding gross and operating profit margins over many years. It is not constantly forced into price wars that decimate its profitability. A commodity business, on the other hand, will have volatile and often declining margins, as it is completely at the mercy of supply and demand and the pricing actions of its competitors. This financial resilience is the tangible evidence of a moat. It's what allows a business to weather economic storms and continue to compound shareholder wealth year after year. When you are performing your stock analysis, don't just look at the last quarter's growth, look at a decade of profit margins. If they are high and stable, you are likely looking at the financial footprint of a powerful and durable competitive moat, the third crucial pillar in your framework for achieving financial freedom. Having established what a franchise is, how to measure it with ROIC, and how to identify its qualitative source through the concept of a moat, we must now turn our attention to the dark side of this equation. We must dedicate ourselves to understanding the trap that ensnares the vast majority of investors, the allure of bad growth. This is the fourth pillar of our system, and it is an exercise in inversion. To truly understand what makes a great investment, we must first deeply understand what makes a terrible one. Bad growth occurs when a company expands in a way that requires massive, continuous injections of capital for unacceptably low returns. These are the capital guzzlers, the businesses that run faster and faster on the corporate treadmill only to find themselves poorer and more exhausted. Learning to identify these companies and avoid them at all costs is just as important as learning how to find the great ones. Avoiding the big losers is a critical and often overlooked component of successful wealth management. Warren Buffett's most profound and personal lesson in the destructive nature of bad growth came not from a company he analyzed, but from the one he bought and whose name he kept, Berkshire Hathaway. In the mid-1960s, long before it was a global conglomerate, Berkshire Hathaway was a struggling textile manufacturer in New England. Buffett, then a young hedge fund manager practicing his cigar butt style of investing, bought control of the company because, on paper, it was cheap. The stock was trading for less than the company's working capital. It seemed like a classic, no-lose value investment. But what he soon discovered was that he had purchased a ticket on a sinking ship in a horrifyingly bad industry. The American textile business was facing a terminal decline. There was fierce competition from low-cost foreign producers, and there was no meaningful product differentiation. A textile is a textile. It's a commodity. There was no brand loyalty, no pricing power, no moat of any kind. The true horror, however, was the industry's capital dynamics. To have even a ghost of a chance at competing, textile mills had to constantly spend enormous sums of money on new, more efficient looms and machinery. This was not growth capital expenditure. This was maintenance capital expenditure. It was money you had to spend just to stay in the game. Buffett found himself in a perverse situation. Any small profit the textile business managed to eke out was immediately consumed by the need to buy new equipment. The faster technology improved, the more money he had to pour into the business. He was running to stand still. He would later describe it as a business where you put more and more money in, and you get less and less money out. It was his foundational lesson in the difference between a good business and a bad business. He saw firsthand that growth in this kind of industry was a trap. Opening a new mill or expanding production would have been an act of financial suicide, as it would have required deploying capital at returns that were far below the cost of capital. This painful multi-year experience with the Berkshire textile mill seared into his mind the importance of avoiding capital-guzzling commodity businesses. It was the negative image that would later allow him to see the beauty of an asset-light franchise like See's Candies in such sharp relief. The psychological trap that keeps both CEOs and investors locked into these value-destroying businesses is the powerful sunk cost fallacy. This is our tendency to continue with an endeavor if we have already invested significant time, money, or effort, even when it's clear that the current costs outweigh the likely benefits. We irrationally escalate our commitment because we don't want to waste our prior investment. Buffett himself admitted to falling for this with the textile mill. For years, he kept pouring money into it, hoping to turn it around, partly because he'd already invested so much. CEOs of capital-intensive businesses do this all the time. They've spent billions building factories and infrastructure. The idea of shutting them down and admitting the capital was misallocated is psychologically painful. So they throw good money after bad, authorizing new projects that they know will earn low returns, simply to justify the continued existence of the original, flawed enterprise. As an investor, you might do the same thing. You buy a stock, it goes down, but you've sunk your capital into it. So you hold on, or worse, you average down, pouring more money into a bad business, because the psychological pain of admitting your mistake and selling at a loss is too great. Recognizing the sunk cost fallacy and developing the discipline to cut your losses when you realize you've invested in a capital guzzler is a hallmark of a mature investor on the path to beating the market. To protect ourselves from this trap, we need a simple, practical mental model, a quick diagnostic tool to spot the potential capital guzzlers. We can call it the CapEx to depreciation ratio. This is a simple check you can perform using a company's cash flow statement. Step 1. Go to the cash flow statement and find the line item for capital expenditures, or CapEx. This is the amount of cash the company spent in a given year on property, plant, and equipment. Step 2. Find the line item for depreciation and amortization, or D&A. This is a non-cash charge that represents the cost of the company's existing assets wearing out over time. Step 3. Compare these two numbers over a long period, say 5 to 10 years. In a healthy, asset-light franchise, CapEx will often be roughly in line with, or only slightly above, D&A. This means the company is spending just enough to maintain its asset base, and its growth doesn't require huge capital outlays. But if you see a company where CapEx consistently and significantly exceeds D&A, a massive red flag should go up. This is the signature of a capital guzzler. It tells you that the company has to spend a fortune, far more than the cost of its assets wearing out, just to maintain its competitive position or to achieve any growth. This simple ratio is a powerful first-pass filter to separate the capital-light compounders from the capital-heavy destroyers. The antithesis of avoiding capital guzzlers is, of course, glorifying them. The 99% of investors often get seduced by the tangible nature of asset-heavy industries. They see the planes, the factories, the oil rigs, and it feels real and substantial. The most notorious example of such an industry, and one Buffett has repeatedly warned against, is the airline industry. For over a century, the airline industry has been a black hole for capital. The growth story is always compelling. More people are flying, global travel is expanding. But the economics are brutal. It is an industry with astronomical fixed costs. The planes themselves are hideously expensive, costing hundreds of millions of dollars each. They require constant, expensive maintenance. Labor costs are high due to powerful unions. Fuel costs are volatile and unpredictable. On top of that, competition is savage. There is virtually no product differentiation between one airline and another. For most consumers, the only deciding factor is price. This leads to constant price wars that destroy profitability for everyone. An airline might grow its revenue by adding new routes, but to do so, it has to take on massive debt or issue new stock to buy the new planes, and then it has to slash fares on those routes to attract customers. It's a textbook example of bad growth. As Buffett famously quipped, if a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville right. He would have saved his descendants a lot of money. He's not wrong. Despite a century of growth, the cumulative earnings of the entire U.S. airline industry for its entire history are negative. It has destroyed more capital than it has created. This leads us to the direct financial connection, the precise mechanism by which these businesses destroy shareholder wealth. It's a concept known as economic value added, or EVA. A company only creates true economic value if its return on invested capital, ROIC, is greater than its weighted average cost of capital, WACC. The WACC is essentially the blended expected return required by the company's lenders and shareholders. If a company has a WACC of 8%, it needs to generate an ROIC of more than 8% just to break even in terms of value creation. Now, consider a capital-guzzling business in a competitive industry, like an airline or a steel manufacturer, that consistently earns an ROIC of, say, 4%. Every time that company's management team decides to reinvest $1 of profit back into the business, by buying a new plane or building a new furnace, they are taking $1 that belongs to the shareholders and turning it into an asset that will only generate 4 cents of annual profit, when that capital had an opportunity cost of 8 cents. They are actively destroying 4 cents of value for every $1 they reinvest. The company's balance sheet gets bigger, its revenues might grow, but the intrinsic value of your share is shrinking. This is the silent portfolio killer. You see growth on the top line and assume you're winning, but underneath the surface, the company's capital allocation decisions are steadily eroding the very foundation of your investment. Learning to identify and ruthlessly avoid these capital guzzlers is the fourth essential pillar in the architecture of long-term portfolio growth. We have now assembled 4 critical pillars. We know how to define a franchise, how to measure its quality with ROIC, how to identify the source of its strength with the moat checklist, and how to spot its evil twin, the capital-guzzling wealth destroyer. But there is one final, crucial piece that connects them all and transforms a portfolio of good companies into a true, self-perpetuating compounding engine. This is the 5th pillar, understanding the art and science of capital allocation, specifically as it relates to reinvestment. It's not enough for a business to be a wonderful franchise that gushes cash. The ultimate long-term return an investor will achieve depends on what that business does with the cash it generates. Does it have opportunities to reinvest that cash back into its own high-return operations? If not, does its management have the skill and discipline to allocate that capital intelligently elsewhere? This is the final and highest level of investment analysis. It is the bridge between identifying a great business and participating in a great long-term compounding story. The greatest case study in the history of finance on this very topic is the story of Berkshire Hathaway itself and its transformation under Warren Buffett. As we discussed, Buffett's initial investment was in a terrible textile business that consumed capital and produced miserable returns. But alongside the textile operations, he began to use Berkshire Hathaway as a holding company to buy other, better businesses. He started with insurance companies like National Indemnity, which had wonderful economics. Insurance companies collect premiums up front and pay claims later. In the interim, they get to invest that money, the float, for their own benefit. This provided Buffett with a steady stream of new capital to invest. Then came the purchase of See's Candies in 1972. As we know, See's was a fantastic franchise that required very little capital but produced a growing stream of cash. Now, here is the masterstroke of capital allocation. A normal CEO of a candy company would have taken the profits from See's and tried to reinvest them in the candy business, perhaps by launching a massive, ill-advised global expansion, or by diversifying into other low-return confectionery products. But Buffett was not a normal CEO. He was a master capital allocator. He saw the cash coming from See's Candies not as candy money, but simply as capital. His job was to deploy that capital into whatever investment offered the best prospective return, regardless of the industry. So the cash that gushed out of See's Candies in California was sent to Omaha. That cash, combined with the float from the insurance businesses, was then used to buy a large stake in the Washington Post Company, another high-return franchise. The dividends and excess cash from the Washington Post were then combined with the ever-growing streams from insurance and seas, and in the late 1980s, that capital was deployed to buy a massive stake in Coca-Cola, perhaps the greatest franchise on earth. This is the compounding engine in action. It is a virtuous cycle. You buy a great business that generates cash. You take that cash, and you buy another great business that generates even more cash. You repeat this process for 50 years. Buffett's genius was not just in identifying the franchises. It was in his discipline of taking the capital generated by those franchises and redeploying it with ruthless rationality into the next most attractive opportunity. He turned Berkshire Hathaway from a failing textile mill into a conduit, a pipeline for moving capital from low-return areas to high-return areas, and in doing so, created one of the greatest records of wealth creation in history. This is the ultimate goal of quality investing. The psychological biases that prevent most CEOs and investors from achieving this level of rational capital allocation are deeply ingrained. The two most powerful are the endowment effect and status quo bias. The endowment effect is our tendency to overvalue something simply because we own it. A CEO who has spent their entire career in the steel industry will view their steel mills with an emotional attachment. They overvalue the prospects of their own business and undervalue opportunities outside of it. Status quo bias is our preference for the current state of affairs. Any change from the baseline is perceived as a loss. For most corporate executives, the status quo is to reinvest all available capital back into the core business, because that's what has always been done. It's the path of least resistance. It takes no imagination and invites no criticism from the board of directors. The idea of shutting down a division, even a chronically unprofitable one, or taking the profits from the core business and investing them in a completely different industry, is a radical departure from the status quo and is psychologically difficult. Buffett's superpower is his complete lack of emotional attachment to any specific business. He views the capital as a tool, and his only allegiance is to deploying it at the highest possible rate of return. This rational detachment is incredibly rare, and it is the key that unlocks the highest levels of compounding. For us as entrepreneurs and retail investors, the lesson is to fight these biases in our own decision-making, to be willing to move capital from a mediocre idea to our best idea without emotional friction. To apply this, we can use a final mental model, the reinvestment moat framework. This is a two-part test for evaluating the long-term compounding potential of an investment. Part 1 is everything we've discussed so far. Does the business earn a high return on capital because it's protected by a durable moat? This tells you about the quality of the existing business. Part 2 is the crucial addition. Does the business have a long runway of opportunities to deploy additional capital at similarly high rates of return? This tells you about its future growth potential. A company can be a great business but not a great long-term compounder if it has no place to reinvest its profits. See's Candies is a good example. It has a fantastic ROIC, but there are limited opportunities to open thousands of new stores with the same profitability. It's a high-quality cash cow, but its reinvestment runway is short. A company like Amazon in its early days, particularly with Amazon Web Services, was the holy grail. It had an incredibly high return on capital, and it had a seemingly infinite runway to reinvest every dollar it earned into building out new data centers, a business that also earned very high returns. This combination of a high ROIC and a long reinvestment runway is the ultimate formula for market alpha. When you find a business that has both, you have found a potential multi-decade compounder. The antithesis of this disciplined reinvestment strategy is the all-too-common path of diversification. This term, coined by legendary investor Peter Lynch, describes the tendency of companies to grow for the sake of growth by making acquisitions in areas they don't understand, often destroying shareholder value in the process. This typically happens when a company has a successful, cash cow core business, a franchise, but has run out of high-return reinvestment opportunities within that business. Instead of returning the excess cash to shareholders, An ego-driven management team will decide to expand their empire by buying other, often mediocre, businesses in unrelated fields. The history of corporate America is littered with the wreckage of such deals. Oil companies buying department stores, software companies buying media conglomerates. These deals are almost always justified with vague buzzwords like synergy, but they are usually just a manifestation of a management team's boredom and desire to run a larger, more complex company. This is the most efficient way to destroy the value created by a great core franchise. It is the polar opposite of Buffett's disciplined capital allocation. For a retail investor, seeing a company you own start to make a string of questionable, unrelated acquisitions is a major red flag that the management team has lost its way. This brings us to the final direct financial connection that ties this entire system together. It's a simple but powerful formula that should be the cornerstone of any investor's thinking about long-term returns. A company's rate of intrinsic value growth is approximately equal to its return on invested capital, multiplied by its reinvestment rate. Let's break that down. Intrinsic value growth approximately equals ROIC * reinvestment rate. If a company has an ROIC of 20% and it can reinvest 50% of its profits back into the business at that same rate, its reinvestment rate, you can expect the intrinsic value of that business to compound at about 10% per year, 20% * 50%, even if the stock market's valuation of the company never changes. This is the mathematical engine of wealth creation. It's not about the stock price going up or down tomorrow. It's about the underlying business becoming more valuable year after year. This formula is the culmination of our entire discussion. The ROIC is determined by the quality of the franchise and its moat. The reinvestment rate is determined by the length of the reinvestment runway and the skill of the capital allocators. When you find a company that scores high on both of these variables, you have found the blueprint for a truly exceptional long-term investment. This is the final promise fulfilled, the ability to look past the noise of the market and identify the true compounding machines, the businesses that can grow and make you rich in the process. You have just invested a significant amount of your most valuable asset, your time, to fundamentally rewire your understanding of the market. You should feel a profound shift in your perspective. You no longer see growth as a single blurry concept. You now possess the high-resolution lens of a master investor. You have acquired the intellectual framework to distinguish the siren song of bad growth from the steady rhythm of a true compounding machine. You can now separate the capital guzzlers, the companies that destroy wealth, from the rare economic franchises that create it. This is not just theory. It is a practical, powerful toolset that can protect your capital and dramatically enhance your ability to achieve real, sustainable portfolio growth. You have moved beyond the 99% who chase narratives and have entered the world of the 1% who analyze economic reality. But mastering this framework, as critical as it is, represents the mastery of only one half of the complete equation for wealth. Identifying the franchise is the first essential step. It's like finding a spring of pure, clean water. However, the ultimate value depends on what you do with that water. A franchise without a brilliant capital allocator at the helm is like a powerful engine in a car with no driver. It generates immense power but goes nowhere. The profits it gushes can be squandered, reinvested poorly, or diversified into oblivion. The second, and arguably more advanced, part of the system is understanding the strategic decisions that transform the cash flow from a great business into an ever-expanding dynasty of wealth. How did Buffett take the profits from See's candies and multiply them 1,000-fold? That involves an entirely different set of mental models, focused not on business quality, but on intelligent capital deployment across an entire portfolio. The video that YouTube is showing you on your screen right now is not an accident. It is the missing link. It is the key that unlocks this second crucial part of the system. It builds directly on the foundation we have just laid, showing you how to think like a true capital allocator, how to take the profits from the franchises you identify and strategically deploy them to create an unstoppable chain reaction of compounding. It connects the analysis of a single business to the construction of an entire portfolio. It is the next piece of the map. The average investor will stop here, content with the knowledge they've gained. They will feel satisfied, and they will drift away. But you are not the average investor. The decision to click is not about watching another video. It is a conscious choice to continue your ascent. It is a statement that you are committed to mastering the complete system, to evolving from a simple stock picker into a sophisticated architect of your own financial future. The next phase of your financial education is waiting. Complete your mental arsenal.